All right, good evening, and welcome to yet another weekly forum with us here at Smartkarma. Um, while we wait for attendees to stream in, I'm going to do the usual, which is a run through the disclaimer and quickly recap some of the ideas we discussed in previous sessions. So, first things first, the Smartkarma weekly forum is strictly for our subscribers. It's meant purely for informational purposes and does not constitute investment advice. It is the opinion not of Smart Karma, but that of our insight providers. And lastly, but importantly, Chatham House rule applies. So please do not share the contents of this forum on social media or any other public forum without prior permission. Okay, let's quickly recap some of the things we discussed in the previous weeks. But before we do that, I must say I'm sort of particularly happy and excited about today's forum because we're looking into the long weekend. B, it's the end of the first quarter, and things have tracked really nicely across our ideas. And also because I think we're at an interesting turning point for markets, having seen a lot of volatility in the last 4 to 6 weeks. Okay, so let's recap. So last week we spent a bit of time looking at Rex International. This is a Singapore-listed small cap, about $250 million market cap, and this is a company that's trading on about 1 times PE and has several potential catalysts, including asset sales, better than expected earnings, stock buybacks, and so forth. Then we took a look at Pinduoduo. This is a large cap Chinese e-commerce company, about $200 billion market cap. And we looked at least 4 reasons why this company's growth prospects are now getting interrupted or derailed, and why the recent departure of the founder should sort of raise more alarms. And lastly, we took a look at the positioning in telcos. This is quite important. We demonstrated to you last week how institutional investors have really sold out of Asian telcos and emerging market telcos in an unprecedented manner over the last couple of years. And now all these telco shares are extremely underowned, and that creates a very, very exciting landscape for opportunity hunting. Then the week prior to that, the 3 ideas that we discussed, we had Samir Taneja, our insight provider, join us and talk to us about Oriental Watch. This is a Hong Kong listed small cap with catalysts and a sort of a dream opportunity for value investors. We looked at Xiaopeng Motors. This is US listed. It's a China electric vehicle company with sort of high growth potential. And we were looking at it because the stock had retreated, almost halved, but it has a very good catalyst roadmap ahead. And lastly, we were looking at the IPO pipeline in Philippines and a very, very clever way to position to benefit from that through owning the Philippine Stock Exchange. So this is just a little bit of a glimpse of how every week we spend a tiny bit of time looking at a sort of a hidden small mid-cap jewel, a large mega cap company, and then also a theme or sector that is especially interesting or exciting. We also spent some time in Q&A and discussion. I remember last week was quite busy. There were a lot of questions on Rex, especially for Nicholas, as he was on the call as well. So I would encourage you to use the Q&A button on your Zoom application to send questions at any point of time. I will get to them either immediately or at the end of the session. So with that, let's kick things off. So the 3 things that we're going to look at today. The first is, just leading on from the theme of telcos, we are going to look at a Singapore-listed telco, which is a hidden reopening play, and sort of a very, very interesting contrarian idea. Then we are going to look at one of the largest companies in Japan, which could have considerable downside. And then in our thematic section, we are going to look at the upcoming direct listing of Coinbase, which operates one of the largest crypto exchanges in the world. Okay, so let's kick things off. The telco idea that we are presenting today is Starhub. And just a few things first. This is a company that used to be a darling. You can see in the mid 2016s, this was almost a $4 stock. Today, it's a $1.28 or $1.29. So it's fallen a heck of a long way. Its market cap today is just 1.6 billion US dollars. So it's tiny. It's a $2 billion market cap company, has about 22-23% market share of the telco market in Singapore, which is not too small a market. And we're going to examine what the thesis is. Okay, so there's a few charts that we should look at when we look at Starhub. So the first chart on the top right is the quarterly revenue chart. And what you will notice is that, the last 4 bars is what I want you to focus on. So when COVID hit, Starhub's revenue dropped significantly. And then, it started to recover towards the end of the year. So why did this happen? One would have thought that tech companies or telcos were beneficiaries of COVID. But what happened for telcos is they lost the international roaming revenue. And that's actually a very, very significant part of the revenue that telcos receive, both on the voice side as well as on the data side for roaming. But I think we have to give a lot of credit to Starhub that even though international travel hasn't resumed, the year-on-year decline in revenue has largely been made up. In fourth quarter, Starhub revenue was down only 5% on a year-on-year basis, which is great, especially in the context that the share price is still at 5-year lows. I think the second very interesting thing is that the previous CEO had embarked on a cost-cutting plan. And actually, this is not as negative as it might sound sometimes. Starhub was not really using a lot of digital services it could use to run a lot of its processes. And as part of this cost-cutting initiative, they've just digitized a whole bunch of things. To give you an example, their customer support has gone online. Their app has seen a lot of improvement. Their billing has gone largely digital and so forth. So $180 million of costs have already been cut. And we think another $20 to $30 million will be cut further. Now, again, given this is only a let's call it 2 billion Sing company, $200 million of cost cut is significant. I think the third thing, just to sort of give you some quantified data. So mobile ARPU stands for average revenue per user per month. So Starhub used to collect about $40 in average revenue per user before the pandemic. Over the course of the year, this $40 has dropped to 30. So we lost about 25% of this revenue. This is largely due to the roaming charges that I was talking about. However, as Singapore goes from 4G to 5G, the 5G plans are anywhere between 10 and 15% more expensive than the 4G plans. In addition, as international travel reopens, the ARPU goes back to 40. So if you think about it, net ARPU can go from 30 back to 40 with reopening, and then go from 40 to about 45 as the population migrates to 5G. So if you think about it, Starhub can grow its ARPU about 50% from $30 to 45. And with companies like telcos, this is all profit. There's very little incremental operating cost associated with this. So there is room for profits to improve substantially. Of course, we've got to wait for the borders to reopen, and we've also got to wait for the migration from 4G to 5G. I think the other quite interesting thing is that competition has declined remarkably. The reason I say that is when you think about 5G, there's only 2 parties that got the 5G license in Singapore. There is Singtel, and then the second party is a consortium of Starhub and M1. None of the other newbie companies have 5G. So actually the competitive position of Starhub looking into the 5G cycle is pretty good. Then they also run a pay TV business. This is small. This is only about 8% of the total revenue. But people were very concerned what's going to happen to Starhub with Netflix coming in and so on and so forth. Starhub has actually taken a very unique approach. Instead of competing, they're partnering up. So for instance, Starhub is now the exclusive partner for Disney Plus in Singapore. And we think there are more partnerships coming as Starhub positions itself as a play around, entertainment, luxury, and potentially even gaming. I think another very interesting thing has happened. In the last few months, a new CEO has joined. His name is Nikhil. Nikhil used to work for Citigroup for a long time. He was the lead in the TMT banking space. So he's a very experienced banker. After that, he had gone and worked for ST Telemedia, and he actually sat on the strategy committee of Starhub for several years because ST Telemedia owns about 56% of Starhub. So he knows the business, but he's sort of new to the company in a way, but also very familiar to the company in a different way. He's very charismatic, he's energetic, and he's really incentivized to move things. And I think I do want to labor the point that the stock is cheap. You've got in fact, it's not even two, it's $1.6 billion market cap. The company makes about $380 million in free cash flow and has a 5% yield. And that's at the lows. From here on, the business should improve further. And I think what's great is everyone, hates Starhub to a certain extent or doesn't own the shares, which is why, they've fallen so much. So this is a very contrarian idea. It's an interesting idea. You're getting paid to wait, and there could be sort of dramatic recovery in profitability over the next couple of years. You've got to be a patient investor with this one, but you've got a lot going for it. Okay. So again, just a reminder, you can ask me questions at any point of time during the conversation, also towards the end. But if not, I'm just going to keep going. The second idea we're going to look at is fast retailing. This is listed in Japan. The ticker is 9983. This is a very, very large company. The market cap is $80 billion. I think a lot of you know it better as Uniqlo. Fast retailing owns the Uniqlo brand, and we're all very familiar with Uniqlo stores. We love them a lot. You can see, this stock has done extremely well, right? It's almost near its highs, but we have a potential bearish thesis on this company. Okay, so there's a lot of very interesting points in here. So just about 10, 12 days ago, on the 19th of March, Bank of Japan announced a dramatic change in the way it buys ETFs. Let me give you some background. So in Japan, the central bank conducts quantitative easing through the purchase of ETFs, and it's about 6 trillion yen of purchases every year. So they announced that as of now, they will no longer be adhering to this quota of purchases. So fast retailing is one of the largest stocks in the index. And now this government buying will disappear. So actually, there is a bit of a technical overhang now from on the stock for that reason. So the stock has fallen a tiny little bit, but despite that, it's trading on 26 times 2-year forward EV to EBITDA. And also 41 times 2 years forward PE. So this is extremely expensive. At the end of the day, this is a retailer, and this sort of valuation multiple is very expensive relative to its own history and also compared to other competitors. Now there's a third negative as well. As of today, which is 1st of April, there is a new law in Japan that mandates that all the displayed prices of products should also include the sales tax figures. This is quite an interesting law. They want the customer to get full transparency on what the total cost would be to buy a particular good. Now, fast retailing has said that in Uniqlo and also GU is another brand that they have, the companies will bear the burden of this 10% sales tax. So what that means is let's say it's a 100 yen product, and with tax, it was going to be sold for 110. Uniqlo will instead only keep 90 and absorb, the 10 yen of sales tax. Now, what's quite interesting is that the GU line only makes 10% operating profit margin. So now if it has to operate under this new scheme where it absorbs the tax burden, GU might effectively become loss-making and sort of a drag on the profitability overall. Now, there's no denying that fast retailing is an amazing company. It's the Uniqlo brand has done extremely well and it's very strong, but there's also no denying the fact that it's an extremely expensive stock. And with a technical overhang, a fundamental overhang, pressure on earnings, not to mention the fact that it's been very inflationary and input costs are going up as well. And in the COVID environment, they might not be able to raise prices. So all in all, this is a great example of a company that's going from great to just good. And that great to good transition can be very painful for large companies, and share prices can struggle or stagnate for a long time. So this is an example of an idea where we are not very optimistic. Now I've got a question that's come in. Okay, it's a question on why Starhub and not Singtel. I think that's a very, very easy one to answer. Singtel, to begin with, has exposure to many countries, not just Singapore. It has telco assets in Indonesia, in India, in Thailand, in Australia. And I think the recovery and the reopening trades are not similar. I think the second thing is that Singtel has also announced that it would be partnering up with Grab to build a digital bank. We think Singtel might have a very distracted boardroom and not have the focus to execute a turnaround for the telco business. Yes, it might benefit to a small extent when Singapore reopens, but Starhub is a cheaper, more direct, more interesting play with potentially a lot more upside. Cool. Okay, I'm going to move on to the last section for today. In this thematic section, we are going to look at the upcoming direct listing of Coinbase. So Coinbase, is one of the leading crypto exchanges. It is a potential $100 billion market cap listing. And I'll just repeat again, this is a direct listing. It's not an IPO. In a direct listing, the company is not really raising any new money, but they're just listing existing shares. And that's, Smartkarma is quite unique as a research platform because not only do we cover equities, credit, FX, macro, but we also look at digital assets and crypto. So let's go through just a few salient points. You can always sort of look at Douglas's insight on the platform. But first thing, it's an operator of one of the largest digital currency exchanges in the world. I think this is the second biggest. The biggest one is Binance. This is a 9-year-old company. They have 43 million retail users and about 7,000 institutional investors. The direct listing is supposed to complete this month, unless it gets delayed. Very recently, the shares have traded hands at a valuation close to $100 billion. This is a very significant increase from its last valuation round of $8 billion in October 2018. From 8 to 100 billion in about 2.5 years. Now, just to put this into context, last year, full year operating income was about $400 million. So a $100 billion valuation on a $400 million income line seems very, very punchy. Now, there's a lot of competition as well. On the retail side, it competes with Square and with Robinhood. These are also very new age companies. PayPal has also introduced products. Binance, as we mentioned, is the leading exchange. They're a big competitor. And there are a few other competitors, Gemini, Bitstamp, Kraken. And I think the interesting thing to note is that as crypto is going more and more mainstream, the competitive intensity is increasing more and more. And also the commission rate for a lot of the trading is actually going to plummet. Today, the margin that Coinbase makes is very high, but we think that the trading fees could go down very significantly. So I think the jury is out whether $100 billion is right or not. You can sort of see which way Douglas is leaning here. He certainly thinks that the long-term prospects are not as great as what the valuation is suggesting, and that certainly warrants caution. With that, we're sort of at the end of today's forum. If you have any sort of last questions, now would be the time to bring them to the fore. But again, at Smartkarma, we invite you to always participate in discussions, post them on the platform. You can always write to us as well. Sometimes some of you have written to also get access to videos from previous forums. Please, we welcome all of that. But if no further questions, I'm going to wish you all a very happy Easter. Do enjoy the long weekend. If you're in Singapore, if you're in other countries and have more holidays, even better. And sort of keep sort of asking us questions and participating in these forums. Thank you and have a good one. Bye bye.